Hey everyone, welcome back. Today I'm breaking down the price-to-book ratio, or PB ratio, one of those fancy finance terms that actually isn't all that complicated once you get the gist. So, what's the price-to-book ratio? Well, in plain English, it's a way to compare how much a company's stock is worth right now to how much the company's assets are actually worth on paper. Basically, it's the stock price divided by the book value per share. Let's say a company owns a bunch of factories, cash, equipment, you name it. If you add up all those assets, subtract what it owes, you get the book value. Now if you take the company's current stock price and divide it by the book value per share, you get the PB ratio. But why should anyone care about this number? Well, investors use the PB ratio to figure out if a stock might be undervalued or overvalued. A low PB ratio, like say under 1, could mean the stock's selling for less than the company's assets are worth. That might look like a bargain. On the other hand, a high PB ratio means you're paying more for the company than it's technically worth on paper. But hold up, a low PB ratio isn't always a deal. Sometimes it means the market thinks the company is in trouble, or maybe its assets aren't really that valuable. And a high PB ratio isn't always bad either. Fast-growing companies or those with lots of intangible assets like tech brands might have high PB ratios, and that's totally normal. Let's take an example just to make this real. Imagine you're looking at two companies. Company A has a PB ratio of 0.8 and Company B has a PB of 4. If Company A has solid assets and a healthy business, that low ratio could mean it's undervalued. But if Company B is growing fast, inventing new stuff, and making big profits, investors might be happy to pay more than its book value. So, when should you use the PB ratio? Honestly, it works best for companies with lots of physical assets like banks or manufacturers. It's not that useful for companies built on ideas, software, or brands. Bottom line, the price-to-book ratio is just one tool in your investing toolbox. It can help spot deals, but it's not the whole story. Always dig deeper, look at other ratios, and understand what makes a company tick before you invest. Thanks for watching. If you found this helpful, hit that like button and subscribe for more straightforward finance tips. See you next time.